And welcome back to another episode of Finance Uncut. On today's episodes, we delve into the markets and the state of the global economy.
Warren Buffett's favorite market indicator nears record high, signaling stocks are overvalued and riskier than ever. And we can see that when we have a look at the Buffett indicator, which is GDP of the Wilshire total market. And that's the top 5,000 stocks on the market. So a broad range of the stock market. And you can see that how highly overvalued the stock market is just on the Buffett indicator alone. It is, in fact, it's the highest it's been at 172 cent, 172.95 or 96 if you want to round it up. But this is the market that we've got, and you can see that the top 5 stocks as a percentage of the S&P 500 market cap is at all-time highs. So that they're those big stocks, and you can see back in the 2000 dot-com bubble where they were there, or the major top 5 stocks anyway, and we called that a bubble. So what does this equate? And how is this going to end? Is this going to continue? Is this going to continue, or is this a bubble? But thanks to the central banks and their constant liquidity pumping into the banking system, as well as now the government's deficit spending and sending checks out to people with a new bunch of Robin Hood. We've seen flows going into the stock market, creating this boom in asset prices, which is also creating a massive wealth inequality gap. But that's really been happening since 1971, and we know why that started happening in 1971. But on behalf of all the billionaires out there, we've now got 5 billionaires that are worth more than $100 billion. First time ever. On behalf of the billionaires, I just want to say a big thank you to the Fed and to all the central banks out there. Thank you very much for making the billionaires wealthy, while the rest of society, the workers and all of us in Slavelandia, get your scraps. Thank you so much. The global debt to GDP ratios hit an all-time high, and this is going back in Q1. So this is an old chart, and so it needs to be updated, and that obviously the debt to GDP ratio is extremely high. US corporate debt versus bond yields. What's interesting is big hedge fund manager Bill Ackman has just shorted the US, or the global corporate debt markets. He did make what was it, about $2.6 billion net profit earlier in the year shorting the corporate debt market, and he's placing the same trade today because he says it's about to explode. That it's just insane right now, and that a lot of companies won't be paying back their bonds. So he sees a massive bond bubble bursting right now, and that's something I've been saying for some time. For those of you who have been following my videos and my presentations earlier in the year, I've been saying the same thing. And what's interesting here in this chart is we've got corporate debt just going up and up and up and up. So while central banks, through their special facility with BlackRock, buying corporate debt because it's against the the Federal Reserve Act to buy corporate debt, they've used a special vehicle, a special purpose vehicle through BlackRock to buy corporate debt. And so what is every company doing? They're issuing corporate bonds to be eaten up by the Fed. And so we're seeing corporates just increase their debt positions, their balance sheet, at the same time that bond yields going down. And this isn't a good thing. Yields generally always track the flow of the movement of the debt, the amount of debt. So if the corporate debt's going down, then yields are going down, and vice versa when it goes up. because corporate debt is a lot more riskier than government debt, treasuries. And so there's a premium that you pay for corporate debt. Now, when corporate debt's going up, then the yields, the interest rate on that debt should be going up also because of that risk premium, but it's going the other way. This is insane. This is absolutely insane what's going on. You can see here, so this is commercial banks. You can see in the blue line, pretty much from the 80s right through to the GFC, banks have reduced their cash assets, or had been reducing their cash assets and just lending like no tomorrow. Where you can see that basically the QE 1, 2, and 3, and 4, and so forth was really just a recapitalization of the banking system, of the commercial banks. And so they've been holding on to a lot more cash assets, yet since the GFC, they haven't really lent out into the real economy. In fact, lending has been pretty stagnant at best since then. But they have been lending. And in the red line, you can see they've been lending to the government by buying treasuries. Now, some say that they've been front running the Fed, basically buying treasury bonds on behalf of the Fed, because once again, the Fed cannot legally, under the Federal Reserve Act, buy bonds directly from Treasury, and so they use commercial banks, the dealer banks, even financial institutions, hedge funds, and the like, to do that bidding for them. And so when they're however, when the Fed is buying bonds from the commercial banks, they're just creating bank reserves held at an account at the Fed. And so it's another form of recapitalizing the banks so that they can create new loans. So when the Fed actually creates those bank reserves, they actually don't go out into the real economy. However, it's very different when they're buying it from hedge funds or from people in the outside of the commercial banking system, the primary dealers. That is a very different kettle of fish. So the banks have been lending. They've just been going, well, we're not going to lend to mum and pop, small businesses or households or whatever, because you guys are risky. We're going to lend it to the US government because, you know what, they are more likely to pay us back with their customers, which is taxpayers, or we'll just sell these bonds to the Fed and get these bank reserves that maybe we'll lend out one day. We'll see. And you can see that in this chart with JP Morgan. So you can see that their total deposits have actually increased significantly, while their lending total loans has been quite stagnant and benign. The gap between the S&P 500 earnings yield and the 10-year Treasury yield. Now, for me, this is another signal of concern. To me, this tells me that the S&P 500 is overvalued, because a 10-year Treasury bond is classified as the risk-free investment vehicle. Okay, so the 10-year Treasury yield is that risk-free yield. And so you base valuations of other assets kind of off the 10-year Treasury yield. And when there's, and stocks, the S&P 500 is classified as higher risk assets. But when the gap between the S&P 500 and the 10-year Treasury yield is so low, to me it signals that the S&P 500, it might not be worth taking that extra risk and that extra volatility to get just such a small margin on the Treasury yield. So we can see that it's fallen quite low from March, so that when the S&P fell in March, you can see that gap was much higher. But since then, that gap is closed, even while the 10-year Treasury yield has actually been falling as the central banks and the Fed has been doing this quantitative easing or bond purchasing program, which reduces the 10-year Treasury yield. So in this one, we have a look at the momentum portfolio versus the value portfolio. And you can see just obviously momentum's been outperforming value for some time. That's no secret. But what's interesting is after the announcement of a vaccine from Pfizer, you can see that the momentum stocks fell quite sharply. So the Zooms and the stay-at-home type stocks fell quite sharply. But what's interesting is the value stocks actually didn't bounce all that much. So your stocks that have been beaten down, like your airlines and your travel and whatnot, have been beaten down somewhat, but they really didn't get much of a bounce. It was more about the that momentum stocks falling. What's interesting is the when you look at the relative valuation of momentum versus value, once again, to me, this is getting very bubbly, very bubbly. And if you were one of these momentum investors and you bought some of these stocks back in March at the lows, or here in Australia, maybe you got onto Afterpay at $8 and rode it all the way up over $100, and it's since fallen back. But perhaps you may want to consider taking some profits off the table, because this is looking quite bubbly for mine. And yeah, so just have a think about that one. The quintile that benefits the most from rising bonds and falling bonds. So you have in the red there, benefit from falling bonds. So your momentum and growth stocks, where your value stocks normally benefit from rising bond yields, and that's because of a couple of things. One, you got a lot of the growth stocks that don't really, some of them don't even make a profit, and so when bond yields are higher, their debt and repayments become higher, and so there becomes a whole question of is this strategy, can they continue to do this strategy in a rising interest rate environment? Because at some point, things don't go so well, if you know what I mean. Where when bond yields are falling, when bond yields are falling, then you can, a lot of people are happy to take that risk. So a lot of these growth stocks that might be just focusing on growing their revenue and just reinvesting everything back into the business, or just borrowing and accumulating other businesses. It's a risky type of play, but for some it can pay off very well down the track. As I said, what you risk is if interest rates go up and all of a sudden you don't have that net profit to service that debt, then you go into bankruptcy and default on that debt and so forth. So that's the risk, but that's what you get there. And the other thing is, generally, these growth and momentum stocks don't pay dividends. Okay, so when you've got a falling interest rates, that means you're getting next to nothing on your bonds and on your savings in a bank account. And so if you're not getting much in terms of dividends, well, you weren't getting much in a bank account anyway. So why not throw it in this fast-growing momentum, the sexy stocks, so to speak, where it's the opposite way for value stocks. Also here, what's interesting is when you look at the US 10-year real rate, so this is adjusted for inflation, and the S&P 500 12-month forward price to earnings ratio, the PE ratio. And what's interesting, so you kind of need to look at this a little bit inverted. So when you see in March, when the stocks were falling, you seen that the 12-month forward PE ratio came down, but also the US 10-year real rate increased. You need to look at that on the right hand side is your US 10-year real rate. So this is adjusted for inflation. And on the left hand side, you've got your PE ratios. And so basically what this is saying is when interest rates are going down, so when the 10-year or real rate, is going down, it is bullish for asset prices. So this is also a headwind for gold. So when we go into negative real rates, which is what we got, so you can see that we're currently got negative real interest rates, this is good for asset prices, including gold, gold and silver. But it's also good for asset prices, home prices, stock prices, etc., etc. And so that's what this chart's saying. So there's a real tailwind there for asset prices. And look, this is what the central banks have publicly said they want themselves. They want to drive interest rates low. They want to drive real interest rates low, so that asset prices and there's that wealth effect, and then mum and pop go, oh well, look, I don't want to miss out too, so I'll jump in and oh yeah, I've made a bit of money, or gains. And so, hey, I feel a bit richer, so now I might go borrow against the increase in this asset, whether it's a house or whatever, to buy another asset or to buy a car or to buy a motorbike or to buy this and that. Or, I'm going to consume more. I'm going to go buy a new stereo system, new this, new that. And, that's good for the overall economy. It's actually not sound economics, but I won't go down that rabbit hole in this video today. So you can see the fall back there in March, and then it's shot up since then. At the same time that corporate profits have basically been going down. And the same thing with GDP and all that. Chris Cole, in his latest interview with Grant Williams and Bill Fleckenstein in the Endgame podcast, was basically saying that that there's no such thing. The stock market no longer resembles any fundamentals. It's all about flows. It's all about flows. It's all about liquidity from the central banks in particular, but it's got nothing to do with fundamentals right now. However, that's going to end badly one way or another. Either they go, you know what, we can't stop. We can't let interest rates go up. Even if we get CPI increases, right? We can't let interest rates go up to combat that CPI rise, because then asset prices will crash and collapse. So we're going to have to stay here. And you can go back to 2018 and have a look at what the Fed did then, when basically they were trying to raise interest rates and reduce their balance sheet. And what happened? The market crashed. You can see it back there in this graph. You can see it. And so they went, whoa, we'll stop this. We're not going to do this. And they stopped offloading those bonds on their balance sheet and kept interest rate, stopped rising interest rates. And so I think we've now got to a position where they're just going to go hell for leather and try to deflate this thing away. Inflate this, the debt away, and keep the asset bubble up. We don't have a free market. Understand that. We do not have free markets, because if we had a free market, then the deflationists would be accurate and would be right, and we would have basically a deflationary depression. So we don't have a free market. We've got central planning with central banks pumping liquidity into the market, which pushes up asset prices. And hopefully people get that wealth effect and go out and spend. However, as I said, it's not based on sound, sustainable economics, and so I think the central banks have backed themselves into a corner on this, and they won't be able to get out of it. And I just let that inflation, that CPI increase, just out of the bottle. Just let it run. I don't see them worrying about that at all. In fact, you can see that all the central banks kind of hinted that they don't really care about that anymore. What also tells me is the market's getting toppy is the put call ratio. So when the put call ratio is at these levels, which you can see, it's always a sign. So basically, everyone's buying call options. No one's buying put options. Everyone's bullish on the market, and this becomes, it's like a contrarian type view. It's become, the optimism has just gone too far, and things are going to pull back the other way. And you can see with the put call ratio, it's at its lowest level right there. So, this also is a sign to me of, once again, things look toppy. It's really all about the flow. However, when you have a look at the smart money, so this, you can see here, we've got the S&P 500 in the blue and the smart money index in the white. Usually the smart money or the S&P kind of follows the smart money. So the smart money is selling and the S&P goes down. The smart money is buying and the S&P goes up. But look at what's been happening lately. So the smart money has been getting out. In fact, it's the lowest it's been in some time. Yet the S&P continues to go up. Or it's been, if you have a look, there's a little bit of a channel there where it's been up and down, up and down, up and down. But it's no longer following the smart money. And this just goes back a little bit further, so you can see that, the S&P does follow that smart money there. And this is what I'm talking about. So the smart money versus the S&P. Smart money got out early, and then the market fell. Smart money got back in, the market came back, and the smart money has since been getting out again, yet the market hasn't reacted yet. You need to look at the insider selling, and the insider selling right now is at the highest it's been for some time. So insiders, these are people that run these corporations. They are selling their own stock. They're selling it to what they consider are the greater fools. So who are you? Are you going to follow the smart money, the insiders, or are you going to follow your neighbor, your taxi driver, and everybody else who's an expert? What's interesting is Pfizer, when they announced the vaccine, the CEO also sold 62% of his stock. Think about that. If insiders selling their stock to everybody else, what is that saying? If they believe valued, their own stock is overvalued. And back to what Chris Cole said. Chris Cole said it's all about the flows, and it's got nothing to do with fundamentals. So you need to watch the flows. And just last week, we had the largest week ever of global equity inflows. That's funds going into the equity markets. And so obviously that was bullish for the equity markets. The flow in the QQQ. So once again, this is a slightly old chart, but this is, so the QQQ is just the index fund that follows the NASDAQ. And it crashed when the flows fell. So it's so important. Watch the flows. If there's flows in, the market's going to go up. When the flows go down or come out, then you're going to see the market come down. It's all about flows, nothing to do with fundamentals right now. So for me, this is somewhere where you can trade. But I wouldn't like to some of these stocks at these prices, these valuations. However, I do own stocks, and I'll probably talk about that more in another video. So this is your, once again, your bonds here, and the flows, moving out of that. So talks a lot about is these passive funds. So index funds and ETFs and all that have become very popular. But even the founder Jack Bogle said that when the index funds become more than 50% of the market, then they no longer serve their purpose and they can actually do more damage, cause more harm than good. And Mike Green says we're at that point now where everyone's in index funds and ETFs, and those fund managers, when they get funds in, like a buy, or someone puts money into a fund, then they have to buy. They've got no choice of sitting it in cash or making decisions or, hey, the market's overvalued. They don't get to make those calls. When you put funds into an index fund, those fund managers have to go and buy shares in that index that make up that index. And then vice versa, when people are selling from that index fund, then they have to sell all those stocks. And the problem is that when the market starts falling, everyone starts to sell in an index fund. Who's the buyer of those stocks moving forward? And there's a massive risk on the downside. If you don't know who Mike Green is, I recommend following him, read some of his stuff, see some of his videos and podcast interviews online. But he's not the only one. Michael Burry from The Big Short also says that the biggest bubble right now, I say it's in bonds, but Michael Burry says that the biggest bubble right now is in passive funds, in index funds and ETFs. And so he thinks this is going to end badly as well. So, once again, the NASDAQ just continues to go up while earnings are going the other way. At some point, the fundamentals have got to count again. So either the market comes down to where the fundamentals are, to where the earnings are, or somehow we have some massive economic boom where earnings just skyrocket and match the prices of assets. You be the judge which one you think is more likely. Same thing here. The S&P 500 return on equity. When the return on equity fell during the tech bust, what happened to the prices? Vice versa, when the return on equity fell in the GFC, what happened to prices? The return on equity has been fairly good over this the last decade, perhaps artificially, but nevertheless, it's been okay. Look at the return on equity now. So the return on equity is heading down while the S&P 500 is going up. But if you bought at the bottom of each of these busts, or even not right at the bottom, but somewhere around the bottom, then you do well. You do well. What you don't want to be doing is constantly buying at the top. On all the valuation metrics, buying assets on the top, because it's like someone pointed out to me, it's like playing blackjack or 21, and landing on 18, 19, 20, and every time you card, yeah, sure, you might get one, you might get two, and you get that 21 hand. But if you do that too often, you're going to lose over the long run. And so one of the reasons I like to buy gold is the M2 per capita. And as I said, so you can see the gray line, that's the 10-year yield, the real yield adjusted for inflation. So when that goes down, that's obviously bullish for gold, bullish for asset prices in general. But gold price tends to follow the M2 per capita. And there's times where gold does become overvalued and other times where gold becomes severely undervalued. And you can see during that period in 2011, gold definitely became overvalued. So did silver. Now, I got a little bit lucky. I will say that I got a little bit lucky. It wasn't just being good at what I do. I definitely had a lot of luck. But I bought gold and silver back in, 08, 09, and within a couple of years, I'd sold it all. In 2011, and then going into 2012, I went over to the US and bought a bunch of real estate. So I turned, it's wealth cycles. So you go from one asset class to another, and I certainly used that to perfection and got quite lucky because I timed it really, really perfect. But you don't have to time these things perfect to do really, really well. But once again, this is an old chart, so this is going back to January this year. And we know that the M2 per capita rate has actually just almost gone vertical. But, so has gold. Gold's done well since, bottoming out around 2015, 2016. It's been moving steadily upwards. Presentations I've done where earlier this year I basically stopped buying gold. Basically, the gold-silver ratio became quite high, which to me says that silver is severely undervalued. And so I started buying just silver. And back in March, silver fell to just under $12 US. And I just completely loaded up on it. I really did back the truck up and loaded up on it. And since then, silver's done really well. It's been one of the best performing asset classes this year. But each time this gold-silver ratio, breaks through these little resistant lines on the gold-silver ratio, silver has that price up run, and you can kind of see here that gold-silver ratio also is kind of breaking through. So does this mean silver will have another run up in price? I certainly hope so. I'm still accumulating silver, still accumulating gold on the dips. But I'm definitely hoping that silver continues this nice run. But it's definitely interesting times in the economy, and there's a lot of debate on this topic about buying gold and silver, and there's a lot of people I think that don't have a good knowledge on investing in gold and silver, yet they think they know everything about it, and frankly everything they say is almost wrong. Almost everything they say is wrong. So anyway, I still like silver. I still think today that silver is the most undervalued asset class around. And I've mentioned that in other videos as to why that's the case, so I won't go down that right now. When you look at the silver to the M2 currency supply, I don't use the word money because it's not. It's currency, it's debt, it's not money. But as the M2 currency supply increases, so that's the broad money supply. I just said it. Slap. Currency supply. Silver should follow that, and based on that, silver is pretty undervalued. Australia, one of the differentiators, I guess, is our yield, so the dividend yield. So in a low interest rate environment, one thing that is attractive, I guess, for the Australian market is our dividend yield. But I mean, 3.7%. Australia's always been known to have a very high, dividend yield. Our stocks always pay high dividend yields, and we've got franking credits and all this sort of stuff. But 3.7% is pretty low. Actually, is very low for Australian standards. Zero or negative interest rate environment. New Zealand have done well. In fact, New Zealand take the gold medal. Their market is annualized return of 14.4% over the last decade. So they're going really well, where Australia's down the bottom there at 4%, just above Hong Kong. So yeah, go you Kiwis. So looking at the Aussie dollar, this is a one thing that I've got lucky with in the past. I definitely think I've got lucky in the past because I definitely uh, struggled in the forex market, but I've certainly got lucky as I mentioned. But one thing to follow to see what's happening with the Aussie dollar is really looking at the flows once again, and are institutional investors and leverage funds, are they shorting or are they buying the dollar? Uh, and the Aussie dollar really does tend to follow that, which you can see from this chart right here. Uh, what's interesting, since the March lows, the Aussie has climbed quite considerably. I think we peaked out at about 74 US cents, and then it's kind of bopped up and down between that 70-cent mark and kind of 72, 73 cents at best. But we've since just seen some institutional investors begin to short the Aussie again. So, it's just a first little signal. Could it happen? I don't know. Keep an eye on this. So for me, I've got a lot of US dollar denominated assets, including US dollars themselves. And I'm following Brent Johnson from Santiago Capital, who just recently told me that he's got a trade on. He believes the Aussie dollar's fallen below 40 cents. That's below 40 cents, not below 50 cents, below 40 cents by the end of 2021, maybe 2022. Look, personally, I hope he's right, because then I'll bring a whole bunch of assets and dollars, convert them from US dollars to Australian dollars, and make a really good play on that. So I definitely hope he's right. So I'm hoping and cheering for a lower Aussie dollar with that. If it goes the other way, well, I've also got a play on that as well, but that's for another video. Look, I just thought I'd throw this chart in here. I found it quite interesting. I don't know if there's really anything to it, but what's interesting is the Aussie dollar seems to follow the S&P 500. Now, this chart once again is a little bit old. Back in September, the S&P peaked and fell. Now, it looks like the Aussie dollar didn't follow suit, but it did. The Aussie dollar actually fell down to 70. In fact, it might have just sneaked 69.99 or something like that. But so the Aussie actually did fall, and since then the S&P has gone up, and the Aussie's back up to around 72 US cents. So yeah, I don't know if there's anything in this. I just thought it was really, really interesting when I saw it, and since September, since this chart finished, it's continued to follow suit. So maybe there is something in here. I just thought I'd share that. Also, I've done previous videos where I'm very bearish still on the Australian property market. And according to Martin North from Digital Finance Analytics, mortgage stress, which is cash flow in, cash flow out, so really it's a solvency thing, is 40.6% of all people with a mortgage are in mortgage stress, meaning, they are close to being insolvent. And this is at record low interest rates, folks. What happens if we get CPI increases? We get this inflation in prices. Prices don't inflate, but if we get this increase in prices, what's the Reserve Bank going to do? What's going to happen to interest rates? Are they just going to leave them down, or are they going to try to fight it? And what happens if interest rates do go up, even to 3%? What if the RBA rose interest rates to 1.5% to 3%? Would it return to 4, 5, or 6%? I remember when I first started broking, anything under 7% was a cheap mortgage. Cheap mortgage. Now, if someone was paying 7% on a mortgage, I'd say right now it'd be disaster. Property market would absolutely collapse, and massive amounts of people would default on their debts. Absolutely, I could guarantee it, because people are struggling right now with the high levels of debt and with the low interest rates. Yeah. obviously the RBA have said interest rates are going to remain low for the next 3 years. They kind of don't really care about that CPI. All they care about is keeping asset prices up. That's the name of the game right now, folks. They're throwing everything at asset prices. It's all about asset prices. Forget about creating jobs, forget about production, forget about savings, forget about any of that. It's all about asset prices. I hope you got that. I hope I said that loud and clear. Interesting chart that I'd put in here. The psychology of a market cycle. You can see the, we go disbelief, hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic. I won't read that one out. Capitulation, anger, depression, and disbelief. So where do you think we are in the market cycle, or in that psychology of a market cycle? So I hear a lot of people talking about, I'm hearing a lot of FOMO out there, folks. I keep my ear to the ground, and I'm hearing a lot of people, just regular folk, working in the cafe, all over the shop, at the gym, whatever. They're like, Afterpay, $100. My neighbor bought it at 10 and he's turned 30 grand into whatever, and blah, blah, blah. Oh, I'm going to jump in now because I don't want to miss out on this as well. Where do you think we are? I think now is the time to be very, very careful. Very, very careful. Now, to finish off this video, I wanted to share this chart, and it kind of goes into my thinking where I'm investing at the moment. So yes, I'm investing in the stock market. I've shared in previous videos that I've got a lot of exposure to gold and silver miners and explorers. That's obvious, because I'm bullish on the underlying asset that they have, and I own a lot of the physical gold and silver as well. But I also am a value investor, and I have bought some businesses, some stocks at between 2 and 4 times earnings. That's dirt cheap. And these are stocks on the ASX. You'd struggle to buy a private business at those sort of multiples. But the industry or the sector that I'm buying these businesses in reminds me of a sector of this stock. So this is the world's most successful company. Had you invested $1 back in 1968, you'd have $6,638 today, while the S&P at $1 would be $87. And no, it's not Berkshire Hathaway. It's not Warren Buffett. Company that this sector is in, since the 1990s, it's been the most successful sector. It's been the most successful sector since the 1990s. So had you invested back in the 90s, you'd be doing really, really well today. Now, personally, I wouldn't invest in this sector, but I'm just using this as an example, because this sector in the 1990s in particular was absolutely smashed left, right, and center by society. There was massive lawsuits against this sector. This sector were no longer allowed to advertise, say, cricket games or sporting events, or hint, hint, Formula One cars. Hint, hint, those that remember the McLaren cars of Prost and Senna. Remember their major sponsor. Started with M, rhymed with Albro. Stock was in that sector. It was the best performing sector, but it was punished in the 1990s, yet that sector has been the best performing sector. Any asset class since the 1990s. And so I'm investing in a sector right now that is currently the pariah of the world. Not called for. It's very unfair. And I certainly like this sector. And it's a beaten down sector, and I'm buying assets in this sector very, 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 very cheap. So anyway, folks, that's it for this video. Hopefully you enjoyed it. Hopefully it's got you thinking about your own portfolio. Perhaps in another video, I'll do another video on my portfolio, which might give you something else to think about as well. But if you like the content that I do on this video, please like, share, and subscribe. I'd love to get this content out to more and more people. And yeah, thanks a lot. I'll see you again on another episode of Finance Uncut.